Thank you, Natalie. The company we're going to be talking about today, if you've never heard of them, that's actually kind of the point, is TSMC. TSMC is one of the most important companies in the world, and somehow almost nobody outside of the industry knows what they do. Every chip that runs ChatGPT, Claude, or Gemini, every chip in your Apple devices, every NVIDIA chip, they all go through one factory operator on one island 90 miles off the coast of China. Today, I want to walk you through their story, how a 54-year-old engineer was handed an impossible job by a foreign government and accidentally built the most important industrial bottleneck of the 21st century. It's quite an amazing story. So what is TSMC and how did this happen? TSMC stands for Taiwan Semiconductor Manufacturing Company. They don't design chips. They make them on contract for the companies that do. Apple designs the brains of the iPhone, TSMC builds it. NVIDIA designs the trained ChatGPT, TSMC builds them. And here's the wild part. Even Intel, supposedly TSMC's biggest rival, is itself a TSMC customer for some of its most advanced products. Isn't it crazy the world's most famous chip company is outsourcing its hardest chips to the company it's been trying to beat for 30 years? Now, how did this happen? Because this is actually quite an interesting story. In 1985, the Taiwanese government called a guy named Morris Chang. Morris is 54, is Chinese-born, MIT trained, and has just been passed over for a CEO job at Texas Instruments after he spent 30 years there. He flies to Taiwan to head up the National Research Lab, basically a government engineering institute. 2 years later, the government comes back to him and says, actually, we want you to start a company, a semiconductor company. We want it to be globally important, and they gave him 3 days to write a business plan. Morris does. The plan is, we're going to build a factory that doesn't design any chips of its own. We're going to be a contract foundry, just manufacturing other companies' designs. At the time, the idea was considered insane. Jerry Sanders, the CEO of AMD, had a famous line about this. He said, "Real men have fabs," meaning that real chip companies own their own factories. The idea of a foundry-only business looked crazy. But here's what Morris had seen at Texas Instruments that nobody else had seen. He'd been watching brilliant chip designers for years quit and start their own companies and fail. Because to design chips, you needed a factory. And to build a factory, you needed billions of dollars. So the talent was trapped inside Intel, Texas Instruments, Motorola, designing chips for someone else's roadmap. Morris's bet was, if a foundry existed that those designers could trust, that promised never to compete with them, an entire generation of chip designers would quit and start their own companies. The market didn't exist yet. He had to build it. And one more thing about how the company started, because this is so different to the world today, Morris was given zero equity. He was essentially a government employee. He built up his stake over the years with his own capital. It took some time before his strategy played out, but chip designers like NVIDIA, Broadcom, AMD, Qualcomm, Marvell were all now viable businesses. Today, TSMC makes about 55% of the world's chips by revenue. But there's an asymmetry to it. They earn over 90% of the profits in the industry. And they make over 90% of the world's most advanced chips. If you're trying to make a chip at the leading edge today, there's only one realistic option. Now that you know what they do, let me pause to show you how the industry is structured. This funnel is what depends on TSMC. 5 layers of the modern economy. Up top, we have cloud computing, AI, high-performance computing. You have mobile phones. You got cars, which today are basically computers with wheels, and a long tail of industrial and IoT. Trillions of dollars of value, billions of users, and devices that you touch every day. All that funnels through the small group of companies in the middle like Apple, Nvidia, AMD, Qualcomm, Broadcom, the fabless designers. They design chips, but they don't make them. And every single one of them for their flagship products ends up at the bottom of the funnel in TSMC. Another interesting point about this picture is that the companies in the middle are bitter rivals. Apple and Samsung are at war over mobile phones, Nvidia and AMD over GPUs, Qualcomm and MediaTek over modems. They're enemies, but they all share the same factory. None of them have a plan B at the leading edge. We saw what happens when this funnel chokes, like we saw during COVID. That shortage wasn't even the dangerous part. That was a trailing edge chips. Those old, mature nodes that are made by multiple foundries from around the world. Even with the redundancy, the system choked up. If the equivalent thing happened to TSMC, leading edge production, there is no second source. No iPhones, no Nvidia, and no Nvidia's AI chips, no flagship Android phones, no AMD chips. The entire premium tech economy just stops. Which brings us to the question we're really here to answer. Is AI a bubble? Because if it is, then TSMC becomes a cyclical foundry instead of a steady long-term investment. So I'm going to spend the next few slides looking at different demand metrics like tokens, hardware prices, electricity usage, and CapEx. And then we will look on the supply side, predominantly on Samsung and Intel. Let's start with tokens. A token is a unit AI models work in. Roughly speaking, a token is a chunk of text. Sometimes it's a word, sometimes it's a few characters. When you ask ChatGPT a question, your prompt is a few tokens going in, and the answer is a few hundred tokens coming out. Tokens are how the industry counts demand. So how much is being computed? Let's start with Google. In April 2024, Google generated 9.7 trillion tokens a month. By May 2025, it was 480 trillion. By July, 980. By October, 1.3 quadrillion. And in the latest disclosure, we estimate this figure is up another 60% to around 2 quadrillion. With OpenAI, you have 900 million people using ChatGPT every day, 18 billion messages a week, 2.5 billion prompts a day. On the developer side, Sam Altman disclosed last October that OpenAI's API was processing about 8.6 trillion tokens a day. 2 years before that, the number was 130 billion a day, a 65x increase. And that was in October. By Q1 of 26, it was up another 60%. If we look at Anthropic, slightly different metric, their annualized revenue went from $375 million from a year ago to $30 billion in April. The CEO told investors they had planned for a 10x growth this year. In Q1 alone, they delivered 80 times. Anthropic is now renting Elon Musk's old data centers because there isn't enough leading-edge compute capacity anywhere else. And one more data point, Microsoft. The AI business, Copilot plus Azure AI, is now $37 billion annual run rate. That's up 123% year on year. 20 million paid Copilot seats sold into enterprise. It isn't trial usage. This is real recurring revenue from companies that have made a decision to make AI part of how they work. So here we have shown 4 different companies. It is not a fad. It is not concentrated in any single name. One more thing before we move on. All of this growth has happened despite a shortage in compute. Okay, second lens, hardware prices. If AI demand were moderating, if the bubble theory were right, you'd expect the cost of renting NVIDIA chips to be falling. That's generally what happens with every commoditizing technology. But GPU rental prices are up 40% in 5 months. And then on the H100, which is an older technology of a couple of years ago. And the third lens is power. This is actually the cleanest signal of all because it's something you cannot fake. You cannot run a GPU without electricity. So if AI is real, it has to show up in the grid. In 2022, global data center electricity consumption was 460 terawatt hours. By the end of this year, it will be over 750. Nearly doubling in over 4 years. To put that into perspective, global data center electricity is now somewhere between Japan and India's entire annual electricity consumption, just for data centers. AI's share of that in 2022, AI was about 5% of data center power. Today it's between 35 and 40, and by 2030 it will probably be around half of all data center electricity globally. Why is this a clean demand signal? Because every one of those megawatts represents a chip that's racked, plugged in, and running. There are no dark GPUs. Hyperscaler utilization is above 90%. When a new chip generation ships, the old one doesn't go into a landfill, it keeps on running. We have not heard of any decommissioned AI data centers yet. But there is a nuance in this chart that I want to point out. First, on the hardware side, each new NVIDIA generation has roughly doubled the AI throughput per watt, going from A100s to H100s to Blackwell to Rubin. Cumulatively, that's around 5 to 10x more useful compute per watt than what we had in 2022. Then there are improvements on the algorithms. These are increases in the efficiencies through better architectures, training, and smarter inference. These improvements are halving the power consumption every 8 months. So when you take those two things together, hardware and algorithm efficiency, the useful AI capability you get from a megawatt today is conservatively 100x what it was in 2022. Here's how it looks like for TSMC side of the equation. 3 years ago, in 2023, AI accelerators were about a quarter of TSMC's most advanced chip output. The big customers was smartphones, mostly Apple, and AI was a side business. This year, AI is 60% of TSMC's leading edge output. Next year, it's projected to be over 80, and so in 4 years, AI has gone from a side hustle to almost the entire leading edge production. What is getting squeezed out is mostly smartphones and computers. A big driver of that has actually been the pricing of both logic and memory and the impact that that's having on the price of the final products like the iPhone. Three years ago, the top 5 cloud companies, Microsoft, Google, Amazon, Meta, and Oracle, collectively spent about $240 billion a year building out cloud infrastructure. By 2025, that was $400 billion. The number people had penciled in for 2026 was around 450 to 550. Then Q1 earnings came about 2 weeks ago, and the picture got a bit steeper. Microsoft will spend $190 billion this year. Google, $185. Meta, $135. Amazon has spent $43 billion in just the first quarter. The top 4 combined will be over $650 billion in 2026 alone. But there's an important detail here. 3 of those 4, Microsoft, Meta, and Google, all name the same single line item when they raise their CapEx guidance: component pricing. There are 2 elements here. The one is memory, and the other is higher prices from TSMC. And to the question of whether this CapEx is reckless, Sundar Pichai, of the Google CEO, has said publicly multiple times that Google would spend more if they could. They're constrained not by their own balance sheet, but by what TSMC and the memory suppliers can physically build. They see the returns on the investment, both from internal usage and from the AI models that they provide. So we've talked about how much AI is being computed, but what does that compute actually buy you? Because if all this compute just made AI 5% better, then yeah, we're probably in a bubble. Here's a popular analogy. Compare AI capability to the education ladder. In 2022, when ChatGPT 4 came out, that was trained on roughly 25,000 chips. The capability level was a high school graduate. It can pass standardized tests, it knows general knowledge, and can do basic reasoning. In 2024, Claude 4 and ChatGPT 5 came out. Those were trained on about 100,000 chips. The capability level was a university graduate. Can pass the actual bar exam, the right working production software, and they do graduate level analysis. Today, the frontier models are trained on around 250,000 chips. The capability level is around a PhD student. They can take on multi-hour research projects. They debug entire code bases without human supervision. They build end-to-end financial models. And we've had a glimpse of the hacking capabilities of Anthropic's Mythos model. In 2027, Rubin Ultra will come out, and those clusters of around 1 million chips. And the expected capability of that will be a senior professional, 5 to 10 kind of years of knowledge work experience. And beyond that, we might get to superhuman genius levels. What we have seen so far, and we are making the assumption that it continues, is that every time a training compute scales 10x, the models climb one more rung up the education ladder. We've gone from high school to university, PhD, senior professional. That's what the additional 10x of training compute is buying. So we've talked about demand. Now let me turn to the supply side. Why hasn't anyone else done this? Samsung is one of the largest, most engineering-rich companies in the world. They have basically unlimited capital. They have the technology. Why are they not catching up? The answer in one word is yield. Yield is the unglamorous term for the percentage of chips that come off a wafer that actually work. When you build chips at this scale, manufacturing defects are unavoidable. The question is, what fraction of your output is good and what fraction is paperweight? At the current 3 nanometer generation, Samsung yields have been stuck at around 50% since production started 3 years ago. TSMC is at over 90. This sounds like an engineering problem, but it's actually a financial one. Because when a customer buys a wafer, they pay the full price whether 50% or 90% of the chips on it work. At Samsung's yield, your effective cost per working chip is almost double. No major customer will sign up for that. So the customer losses have piled up. Qualcomm's flagship Snapdragon has moved entirely to TSMC. Google's Tensor chips have moved to TSMC. NVIDIA's Rubin went to TSMC without any serious Samsung evaluation. Even Samsung's own phones now use Qualcomm chips made by TSMC for some of the flagship models. Samsung is losing customers in its own backyard. This could change, but capacity is an even bigger bottleneck at Samsung or Intel. The chart on the left, you can see the scale of the production gap, and by the end of this year, TSMC will be producing 280,000 wafers per month at the most advanced 3 and 2 nanometer nodes combined. Samsung's 2 nanometer target is about 21,000 wafers per month. Intel's first 18A fab in Arizona starts at around 10,000. TSMC is producing 10-1 against its 2 main competitors combined, and with Samsung and Intel, a lot of that production is actually for internal use, not for external customers. Then there is also the switching costs to consider. NVIDIA can't call up Samsung tomorrow and say, we're moving production over to you. It takes 2 to 3 years to prepare the fabs, get the process right, get the yields up. The chip designers are working with TSMC today on chips that will only come out in 2 to 3 years' time. Why is catching up so hard? Besides working with the most advanced machines man has ever created, there is a continuity to learning. You build up knowledge and know-how through every iteration, and the iterations are not particularly cheap. Here's what I mean. TSMC spent $30 billion on CapEx in 2022, $38 billion in 2024, over $50 billion this year. And every dollar of this year's CapEx is funding the research and the tool orders for a chip generation that will be in production 3 to 5 years from now. You miss a year and you've missed a generation. And here's also an important detail. You cannot skip generations. The physics and the process knowledge needed at each node builds directly on the one before. A new player can't go from 3 nanometers to 1.4. They have to do 3, then 2, then 1.8, 1.6 in sequence. And each step is harder than the last. Intel learned this the hard way. In 2016, Intel had a delay at 10 nanometers at just one node, 3-year delay. That single missed generation cascaded. Intel lost the data center CPU lead to AMD, which was using TSMC. By the time Intel got 10 nanometers working, 5 years of compounded process learning had been lost. They are still catching up today. One missed generation, 10 years later, and they're only kind of starting to come right. So when you hear about the new entrants like Elon Musk's Terafab or Japan's Rapidos, the new CHIPS Act fab in Arizona, it's not enough to build one factory. They need to commit to a multi-year, multi-$100 billion investment path executed without major missteps against a competitor with 30 years of cumulative learning. That is the real moat. Now let me give you a little bit of a more mathematical way of why this industry favors one winner. There are 2 laws that govern this business. The first, you've probably heard of, is Moore's Law. Moore's Law states that compute per chip doubles every 2 years. That's been roughly true for about 60 years. What Moore's Law rewards is scale. The more volume you run through your factory, the lower your unit costs, the more you can invest in the next generation. So Moore's Law makes the big get bigger. The second law is much less famous. It's called Rock's Law. Rock's Law says that the cost of building a leading edge fab doubles every 4 years. Today's fabs cost about $30 billion. Next generation will be 60, and the one after that will be well over $100 billion. Now combine those 2 laws. The bigger you are, the cheaper you can produce, and the upfront cost of producing doubles every 4 years, and that leads to consolidation. And historically, that is what we've seen. In the early 2000s, there were 22 players making chips at the leading edge. By 2021, we were down to 2 players, essentially TSMC and Samsung. By the next transition, we would be down to 1, but geopolitics will probably keep more alive. TSMC is one of the bottlenecks, but it's not the only one. There are others. The biggest other bottleneck is memory, specifically the kind of memory called high bandwidth memory, which is very integral to AI. High bandwidth memory is made by 3 companies, SK Hynix, Samsung, and Micron. There's a huge shortage of supply, and prices are up significantly in the last year. The second is equipment, the machines that make the chips, the suppliers to TSMC. There's one Dutch company, ASML, that makes the most advanced of those machines, the EUV lithography systems. ASML itself is a monopoly, and they are the only company in the world that makes those machines. If ASML cannot ship enough tools, TSMC can't expand capacity. The third is advanced packaging. This is the way the chips get stacked together into a single package. TSMC does most of this in-house, but it is another capacity bottleneck. And the fourth is electricity. Total power output in the US has stagnated over the last 2 decades. Suddenly today there is a need to build power plants, substations, transformers, grids, but the capacity and the skills are not there to meet the demand. Now, none of these are currently broken enough to break the thesis, but they're worth watching because a thesis like this is not just TSMC on its own. There are 3 key risks worth taking seriously, worth talking about. The first one, and this is really the big one, is Taiwan. There is no plausible replacement for TSMC outside of Taiwan for 3 to 5 years. Any scenario involving military action in the Taiwan Strait is catastrophic, not just for TSMC, but for every Western technology company that depends on them. This is the standoff part of what we're talking about today, and it's real. You might hedge it by owning an Intel or a Samsung because they would have the chance to catch up and the only ones who could supply the chips. TSMC is investing in backup capacity in Arizona, Japan, Germany, but those facilities are years away from leading edge production. The Arizona fab makes chips, but it makes chips a generation or 2 behind what Taiwan is producing. So if you're worried about Taiwan, you are worried about TSMC. Number 2 is customer concentration. Currently, Apple and NVIDIA together are about 35% of TSMC's revenue. Apple has recently signed an agreement with Intel. There are no real details about it, but it would probably depend on Intel's progress on the latest node and the ramp up, which is still a few years away. It is also Apple's way of geopolitical risk. The third one, and this is a bit of a longer term one, is the next transistor architecture. TSMC's current lead is built on specific transistor designs. The next generation requires new physics and new equipment. If a competitor gets there first, the moat narrows. These architecture transitions are when industry leadership has historically changed hands, so it's a watch point, but it's still a few years out. So we've made the case for the company. The next question is, at what price? Since we've put these slides a couple of weeks ago, it was on a 19.3, it's now on a 21 times forward PE. The return on invested capital is at around 26. Return on equity is at 35. The 5-year revenue growth historically has been 23% annualized. Gross margins are running at over 65% and projected to keep climbing with a new generation of chips. The balance sheet has a net cash position, meaning that the $50 billion annual capex program is entirely self-funded. They don't need the bond market, they don't need a rights issue. They print money and reinvest it at a very high return. Conservatively, on our numbers, TSMC will grow at over 25% per annum through volume growth and pricing power. Even if there is no re-rating, there is a pretty decent return over the next few years. And that is why it's a core holding in our portfolio. Thank you.